Hi, Jonathan York from Bay Financial Partners, looking at the investment markets. Still pretty choppy out there with the ongoing spat between the US and China in terms of the trade war. Now, at present, both sides seem to be playing pretty much hardball. Trump is pretty adamant that the US can survive and it doesn't need China and it can sort of take the high ground. It won't be impacted as much as China because the US economy is sort of coming from a much stronger state. Interesting, obviously, China's hit back and has sort of put on hold the purchase of US soybeans. That's certainly going to hit the agricultural sector in the US pretty hard. But also rare earth minerals. China is the great supplier to the world economy on that, supplying about 30-35% of the rare earth minerals. These are used in sort of high-tech developments, etc., and really is a pretty major blow. What China is able to do is that they're able to obviously supply Chinese companies at obviously a much reduced rate, whereas placing restrictions on external purchasers outside of China. Now, at the moment, the impact on the US economy has been relatively sort of minimal, despite President Trump's claim that China would be paying all of the tariffs. The IMF have done some work on that, and it's actually the US consumer and US companies that are paying most of the tariffs. But also as well, most of the economists and analysts and investment banks are sort of pointing that the longer this drags on, the more negative it is for the US economy. That economy is currently growing at around sort of 3.1%. It's expected to sort of dip back a little bit over the next sort of 12 months to around sort of 2.6, 2.7. But that's really very much dependent on this sort of trade war getting sorted out really within the next sort of 3 to 6 months. If it drags on much longer than that, then obviously the impact will be much greater. Now, it will be very interesting to see the Fed's reaction to this sort of ongoing, sort of trade dispute and how it's impacting the US economy. At present, the sort of bets and odds in terms of a rate cut before the year end are about sort of 50-50. Interesting this week as well, Special Counsel Mueller has actually given his first sort of public statement regarding the investigation into President Trump, and really was quite interesting in what he sort of had to come out and say. He said that if they found no evidence that President Trump hadn't interfered with any of the sort of ongoing investigations and what he was being investigated for, then they would have said so. Now, that appears to be sort of a clear indication that although they couldn't find anything to prove that President Trump was guilty, he wasn't totally innocent either. Now, obviously, to be expected, Trump has taken the high ground and said that he basically should have come out and said I was innocent. They couldn't find anything to sort of take a case forward, therefore I was innocent. That is clearly not the case. Oil's certainly been impacted pretty hard. It's fallen about sort of $6-7 over the last couple of weeks. Back at WTI now back around sort of 56.5 per barrel. In the UK, obviously, you've got Prime Minister May stepping down in the first week of June. She will then become the sort of caretaker Prime Minister until a new leader is found. What really seems pretty naive and strange is that the UK government and Conservative Party seem to think that if they elect a new leader, then all of a sudden their problems will be resolved. You've still got the same issues with Brexit. You've got the same MPs that are refusing to back any deal, and you can't just see how changing a leader is going to change anything. The fundamental core issues are still there. You don't have enough support for a Brexit deal. After the surprise result from the Australian election, Scott Morrison and his majority government, that appears to be pretty good news for the Australian economy. Certainly it takes the sort of franking credit issue out of the equation. Investors seem a lot more confident, and that Australian economy probably should look to push on now over the next sort of 12 to 18 months. Here in New Zealand, it's certainly been a long week for the government. The much heralded wellbeing budget really turned into a bit of a debacle. You had supposedly the leak, the hack into the Treasury website in terms of gaining the budget before it was released yesterday. That transpired actually to be nothing more than just people searching their website, hitting the search bar and typing in a search request. Obviously very embarrassing for the government. In terms of actual delivery, it seems to be sort of applying money to the right causes and right issues, but there's no real targets out there, and potentially does fall a little bit short of what they were promising. Now, yet to see how that's obviously going to impact on the New Zealand economy. Certainly the initial reaction in terms of the currency and interest rates was pretty muted. But then again, as discussed, there was quite a bit of leakage beforehand in terms of the sort of details and what sort of areas where they're going to be receiving the money. One thing is clear that certainly interest rates in New Zealand will remain low for quite some time. That's obviously pretty major sort of implications out there for savers. Now, say if you are looking for income options, there are plenty of alternatives available out there. You can call us on 0800 867 323 or go to the website www.bayfinancialpartners.co.nz. Good time to be checking those KiwiSaver balances just to make sure you've made enough contributions out there to get the maximum tax credit. While it's not quite free money, as long as you put in that 1,042, you do get the 521 given back in terms of tax credits into your KiwiSaver account. Now, if you're unsure on what those numbers are, say call us on 0800 867 323.